On April 16, 2025, the global financial system was processing routine transactions at a scale that would have been incomprehensible a generation earlier. Every second, thousands of payment instructions moved between banks across borders and continents. Currency exchanges, securities settlements, corporate payments, international trade financing. All of it flowing through interconnected clearing systems that had become the circulatory system of modern commerce. The Society for Worldwide Interbank Financial Telecommunication, SWIFT, was handling approximately 47 million messages per day. Each message represented money in motion: a pension fund buying Japanese bonds, a European manufacturer paying Chinese suppliers, an oil company settling crude purchases, a tech company transferring payroll to 17 countries simultaneously. The system had become so reliable, so fundamental, that it was essentially invisible. Money moved at the speed of light through fiber optic cables, and nobody thought twice about it. At 09:14 UTC, deep in the transaction processing infrastructure that underpinned global finance, something began to change. The change was measured in microseconds, millionths of a second. Transaction processing times that normally took 180 microseconds were taking 183 microseconds. Settlement confirmations that should have arrived in 220 microseconds were delayed by 4 microseconds. The differences were infinitesimal, far below the threshold of normal monitoring systems, well within acceptable variance for network latency. But they were growing. At 09:31 UTC, a quantitative analyst at a high-frequency trading firm in London noticed an anomaly. His algorithmic trading systems were designed to execute transactions in microseconds, exploiting tiny price differences across markets faster than human traders could perceive them. The algorithms had stopped executing. Not crashed, just stopped. The profit opportunities were still there, visible in the market data feeds. But by the time his orders reached the clearing systems and returned with confirmations, the opportunities had closed. His execution times had slowed by approximately 15 microseconds. In high-frequency trading, 15 microseconds was an eternity. He assumed it was a problem with his firm's systems. He ran diagnostics on their trading platform, checked network connections, verified processing speeds. Everything showed normal. The delay wasn't in his infrastructure. It was in the settlement layer. The systems that actually moved money between banks after trades were executed. Those systems were processing his orders correctly, but fractionally slower than usual. Slow enough that his competitive advantage had evaporated. At a major European clearing bank, transaction reconciliation systems were flagging minor discrepancies. Settlement times across thousands of transactions were showing consistent delays. The delays were tiny, averaging 8 to 12 microseconds, but they were systematic. Every transaction was slower. It was as if the entire financial messaging infrastructure had suddenly become slightly less efficient, as though the fiber optic cables had somehow gotten longer overnight. The operations team investigated. Network performance appeared normal. Server processing times were within expected ranges. Database queries were executing properly. But end-to-end transaction times, measured from when a payment instruction was submitted to when settlement confirmation was received, showed persistent delays. The delays weren't large enough to trigger automated alerts or violate service-level agreements. They were just there. A subtle drag on system performance that shouldn't exist. At 10:07 UTC, the pattern expanded. Banks in New York were reporting similar delays as European markets opened for cross-Atlantic trading. Asian financial centers finishing their trading day showed the same microsecond-level slowdown in transaction processing. The delays were global, affecting all institutions connected to international clearing systems. It wasn't network congestion. It wasn't processing load. The systems were operating normally in every measurable way except for this persistent, unexplained latency. By 10:45 UTC, the delays had grown to an average of 23 microseconds. That was still less than a thousandth of a second. Human perception operates at scales of tens of milliseconds. Humans wouldn't notice a delay of even 100 milliseconds. But financial systems operate at much finer timescales. High-frequency trading algorithms execute in microseconds. Currency exchange rates fluctuate in microseconds. Payment systems route transactions based on microsecond precise timing. A 23-microsecond delay was starting to affect real operations. Foreign exchange markets were experiencing unusual volatility. Currency traders rely on precise arbitrage, buying in one market and selling in another when prices temporarily diverge. The execution speed determines profitability. With transaction times delayed by 23 microseconds, arbitrage windows were closing before trades could settle. Automated trading systems were pulling back from the market because their execution speeds no longer gave them the edge they needed. Market liquidity was decreasing. Bid-ask spreads, the difference between buying and selling prices, were widening. The delays were invisible to most market participants, but they were creating friction in the machinery of global currency exchange. At 11:18 UTC, a senior systems architect at SWIFT headquarters in Belgium identified a pattern in the transaction delays. The latency wasn't distributed randomly. It was concentrated in specific routing paths through the network, paths that handled the highest volumes of traffic. Messages routed through primary data centers showed 25 microsecond delays. Messages routed through secondary paths showed normal timing. It was as if the main highways of international finance had developed traffic jams invisible to normal monitoring. He pulled diagnostic logs from the core routing systems. The servers showed normal CPU utilization, normal memory usage, normal network throughput. But buried in detailed timing logs, he found something wrong. Cryptographic validation processes. The security checks that verified each transaction message was authentic and unmodified, were taking fractionally longer than they should. Each message had to be cryptographically signed by the sending bank and verified by the receiving bank. That verification normally took 127 microseconds. Now it was taking 152 microseconds, 25 microseconds added to every transaction. Multiplied across 47 million messages per day, that was an additional 1,175 seconds of processing time injected into the global financial system, nearly 20 minutes of accumulated delay distributed across millions of transactions. It was small enough to be invisible individually, but large enough to create systemic drag when aggregated. The cryptographic verification was taking longer because the verification keys were being checked against an additional validation layer that shouldn't exist. Deep in the security infrastructure, someone had inserted an extra verification step. The step did nothing. It simply checked the digital signature twice instead of once. The second check was redundant, unnecessary, and completely invisible unless you were looking at microsecond-level timing logs. But it added 25 microseconds to every transaction. At 11:34 UTC, the systems architect escalated the issue to SWIFT's cybersecurity team. They began forensic analysis immediately. The extra verification layer had been added to production systems 2 weeks earlier during what appeared to be a routine security patch. The patch had been properly signed, properly documented, and properly tested. It had passed all quality checks. Nobody had noticed that it added a redundant verification step because the testing focused on functionality, not microsecond-level performance. The security team pulled the complete change history for the patch. It had originated from SWIFT's software development environment, been reviewed by senior engineers, tested in staging systems, and deployed to production following standard procedures. Everything appeared legitimate. But when they compared the deployed code to the original patch documentation, they found a discrepancy. The documentation described the security enhancement accurately. The actual code included that enhancement plus one additional line, a line that activated the redundant verification check. Someone had modified the code between the final review and production deployment. The modification was subtle enough that it didn't affect functionality and wouldn't be caught by automated testing. It simply made every transaction slightly slower. The insertion had required access to Swift's production deployment systems, knowledge of their security architecture, and understanding of precisely where to place code that would affect timing without triggering alarms. This was a supply chain compromise, not of physical equipment or external vendors, but of Swift's own internal development pipeline. The attacker had infiltrated their software deployment process weeks earlier and had been waiting for an opportunity to inject malicious code into a legitimate patch. At 11:52 UTC, the cybersecurity team made a critical discovery. The microsecond delays weren't the attack. They were preparation for the attack. The redundant verification step was designed to slowly accumulate timing drift across the global financial network. As transaction processing times increased, settlement systems would gradually fall out of synchronization. Banks expect settlement confirmations to arrive within specific time windows. When those confirmations are consistently delayed, even by microseconds, settlement systems begin queuing transactions for retry. The queues build slowly, imperceptibly, until they reach a critical threshold. That threshold was approximately 45 microseconds of average delay. At that point, settlement systems would begin experiencing cascading failures. Transactions would be queued for retry. The retry attempts would add to processing load. The increased load would slow processing further. More delays would trigger more retries. Within approximately 90 minutes of crossing the 45 microsecond threshold, the mathematical model showed complete settlement system collapse. Banks would be unable to confirm whether transactions had completed. Payments would be frozen in an indeterminate state. The global financial system would effectively seize up. At current rates, the system would cross the 45 microsecond threshold at approximately 14:20 UTC. That gave them 2.5 hours to remove the malicious code and restore normal processing times before the cascade became irreversible. But the deeper analysis revealed something more alarming. The redundant verification check wasn't just slowing transactions, it was collecting timing data. Every transaction passing through the compromised systems was being logged with microsecond precision. The logs included transaction routing, counterparty information, and settlement timing. The attackers were building a detailed map of global financial flows. They could see which banks transacted with which counterparties, at what volumes, with what timing patterns. They were mapping the invisible architecture of international finance. At 12:08 UTC, Swift initiated emergency procedures. They had to remove the malicious code from production systems while those systems were actively processing millions of transactions. Taking the systems offline wasn't an option. That would instantly halt international payments and trigger the exact cascade failure they were trying to prevent. They had to patch the running systems without interrupting transaction flow. The technical team prepared a hotfix, a minimal code change that would remove the redundant verification step without affecting any other security functionality. But deploying a hotfix to global financial infrastructure while it was processing live transactions was extraordinarily risky. If the hotfix introduced any bugs, even minor ones, it could corrupt transaction data or cause settlement failures worse than the microsecond delays. They tested the hotfix in isolated staging environments. The tests showed it worked correctly and restored normal timing. But staging systems don't replicate the full complexity of production load. The team couldn't be certain the hotfix would behave identically under the pressure of 47 million transactions per day, distributed across hundreds of institutions in 200 countries. At 12:34 UTC, the decision was made. The risk of cascading settlement failure outweighed the risk of the hotfix potentially introducing issues. Swift began rolling out the fix to production systems in waves. Primary data centers first, then regional hubs, then secondary systems. Each wave took approximately 8 minutes to deploy and validate. During deployment, transaction processing would slow slightly as systems adjusted to the code change. But that slowdown was preferable to the alternative. The rollout began at 12:41 UTC. Transaction timing showed immediate improvement as each system was patched. The microsecond delays began decreasing. By 13:15 UTC, the hotfix had been deployed globally. Average transaction latency dropped to 188 microseconds, slightly higher than the optimal 180 microseconds due to residual queue clearing, but well below the 45 microsecond threshold that would trigger cascading failures. Settlement systems stabilized. Currency exchange markets returned to normal liquidity. High-frequency trading algorithms resumed operations. The global financial system continued processing transactions without most participants ever knowing how close it had come to systematic failure. But the investigation was just beginning. The NSA had been monitoring the situation since 10:15 UTC when their financial network analysis systems detected anomalous patterns in international transaction timing. They had independently identified the microsecond delays and had been tracking the potential for settlement cascade when SWIFT discovered the root cause. NSA forensic teams joined SWIFT's investigation to trace the supply chain compromise. The attacker who had modified the deployment code had accessed SWIFT's systems through compromised credentials belonging to a senior software engineer. The credentials had been stolen 6 months earlier through a sophisticated spear phishing campaign. The engineer had received an email appearing to come from SWIFT's IT department, asking him to validate his credentials through a link that led to a fake login portal. The portal captured his username and password, then redirected him to the real SWIFT system so smoothly that he never realized he'd been compromised. For 6 months, the attackers had those credentials but hadn't used them. They waited, mapping SWIFT's internal systems, understanding deployment procedures, identifying the optimal point to inject their code. When SWIFT deployed a legitimate security patch 2 weeks earlier, the attackers used the stolen credentials to add one additional line to the code during the final deployment step. The modification was timestamped and attributed to the engineer whose credentials had been stolen, making it appear completely legitimate in audit logs. The timing data the attackers had collected was exfiltrated through SWIFT's standard network traffic, disguised as routine system telemetry. Over 2 weeks, they had gathered timing information on approximately 658 million transactions representing over 2.1 trillion in daily payment flow. They knew which banks were most active in which markets. They understood settlement patterns for major corporations. They had visibility into international money movement that would normally require access to dozens of financial institutions. The data theft was concerning, but the near miss of system collapse was catastrophic in its implications. If SWIFT's internal team hadn't caught the microsecond delays when they did, the system would have crossed the cascade threshold at 14:20 UTC. Settlement failures would have begun propagating through global banking networks. By 16 UTC, major banks would have been unable to confirm transaction status. By 18 UTC, international payments would have been frozen. By midnight, the entire global financial system would have been in crisis, with trillions of dollars in transactions stuck in indeterminate states. The economic impact of even a partial settlement system failure was difficult to calculate, but would easily exceed 500 billion in the first 24 hours. International trade would halt when importers couldn't pay exporters. Supply chains would freeze when just-in-time payments couldn't clear. Stock markets would suspend trading when settlement systems couldn't confirm transactions. The cascading effects would propagate through every sector of the global economy within days. By April 17th, new monitoring systems were being deployed across financial messaging infrastructure. Banks implemented microsecond-level transaction timing analysis. Settlement systems were upgraded with additional redundancy and faster failover capabilities. Swift completely restructured their software deployment security, implementing multiple independent verification steps and eliminating single points of compromise. But the fundamental vulnerability remained. Global finance had optimized for speed and efficiency. Transactions processed in microseconds across thousands of institutions. The system worked because it was carefully synchronized, with each component trusting that others would perform within precise timing windows. That synchronization was the system's strength and its critical weakness. An attacker who could manipulate timing by even microseconds could potentially cascade the entire infrastructure into failure. The attack had demonstrated something that financial institutions had been reluctant to acknowledge. The global financial system operated with very little margin for error. Microsecond-level delays that were too small for humans to perceive were large enough to destabilize settlement systems processing trillions of dollars daily. The automation and speed that made modern finance possible also made it vulnerable to subtle timing attacks that traditional security systems couldn't detect. On April 16, 2025, international financial messaging systems were processing normally. Transaction times showed minor variations, microseconds of delay that monitoring systems categorized as routine network variants. But those microseconds were accumulating. Settlement systems were drifting toward cascade failure. Within hours, the infrastructure that processed 2.1 trillion in daily transactions would have frozen. Unable to confirm whether money was moving or stuck, whether payments had cleared or failed. The delays were caught. The code was patched. Systems stabilized. But the attack revealed how precisely calibrated global finance had become and how easily that precision could be weaponized. Microseconds of added latency, invisible to almost everyone, were enough to threaten the entire system. The financial infrastructure is operating normally now. Banks process payments. Settlements clear. Markets trade. But the timing precision that makes that possible is also what makes it fragile. The demonstration was clear. You don't need to break the financial system. You just need to slow it down by less than 1,000th of a second and let it break itself.